Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me Chris Hanson with Hanson Capital Group. They have two locations, one down there in Scottsdale, and I think you got some presence in LA as well. Thanks for joining me, Chris.
Yeah, thanks, Lance. Glad to be here.
Yeah, so we were just chatting before we hit record. So Chris is from Lake Oswego, Oregon, which is where I'm recording this from. Our office, my day job at Veravest is located here in Lake Oswego. So Chris grew up here. We have some mutual investors and things, so it's always good. I met these guys at a conference in Vegas, so it's a small world out there, and happy to have them on the show. Just a bit of preface: we have Chris jump in and sort of share. These guys, they do quite a bit. You start to see more and more of this, where you got vertical integration, and then you've got people who are sort of have expanded their investment firms to do multiple things. So today we'll probably spend a little bit more time talking about the state of kind of industrial properties. Chris and his team do a lot of development of multifamily, which he'll get into, multi-value add investing, as well as, lending and a debt fund and all sorts of things. So Chris certainly has sort of done quite a bit in this industry. So it'll be good to sort of pick his brain. But why don't you share with us, Chris, how did you end up getting into the real estate business? So what attracted you to it initially? And always curious that origin story that led you to the formation of your own firm.
So I like to give credit initially to Sharon Lechter, who wrote Rich Dad Poor Dad with Robert Kiyosaki. Mm-hmm. She actually came down and spoke to our entrepreneurship class. That was my major in college at U of A. And she came and spoke at the college one time. I met her, read the book, and was like, wow, that, passive income, cash flow, wealth creation. I love it. That's where the seed kind of started. Mm-hmm. I ended up getting into mortgage out of college, wholesale mortgage with Wells Fargo, and kind of learned the debt space. And when that all cratered, I went into the foreclosure business and bought my first property. Kind of the rags to riches story, actually. Cash advanced a credit card in 2008 and bought the first house at the foreclosure auction for $36,000 and did a fix and flip. And then bought a couple more and, brought in the first couple investors in 2009 to help fund those. We created an auction bidding company that focused on foreclosures at the trustee sales here in Phoenix. And that company was started simply because in those days you'd pay $3,000 to have somebody go stand at the auction at the courthouse steps and bid on a house, $3,000 bid fee. And I thought that was outrageous because I think I bought 3 in 1 month. I could for sure hire somebody to stand there for less than $9,000 for that month. And we did some guerrilla marketing and got out there and kind of created a brand for ourselves, and we cut the price in half, and we were the $1,500 bid fee company. Maybe a year after that, I bought the first multifamily building, little 7-unit. The fix and flip of houses was not my strong suit, although I've owned companies related to that vertical for a long time. We bought the first multifamily out of foreclosure, little 7-unit deal, and then we bought a 16-unit deal, and that has continued, and that's where our mutual investors and I got connected. And I think 13, we bought an asset together. But we've bought and flipped about 3,000 apartment doors over the last 13 years. And in 2009, as part of our auction company, we started doing lending. I had an investor who had some money and said, hey, why aren't you offering loans to these guys? These guys could do more, because as you know, at the trustee sale, you got to pay cash within 24 hours. So I thought that was a great idea. I started lending as kind of a lost leader. I was paying that guy to lend money to my customers because then I could do more bids. Yeah. I was doing all the servicing, and that turned into a mortgage bank that got licensed in 2009. And that's where we have a debt fund today that, hard money lending, along with value add real estate kind of go hand in hand.
Yeah.
So we've got, that's led to kind of having multiple options for our investors. If they want stable money with cash flow, we can do debt. If they want value add, bigger risk, maybe a little less cash flow, we do the value add stuff. And that's the fund we started with Tarek El Moussa from HGTV to buy multifamily properties. We're just not very active with it. The returns are not there today, which has probably led to our main topic, right?
Yep. Yeah, exactly. I mean, as you've seen, it was obviously a good time. Yeah, you get in the market, especially after it cratered the way it did and coming up there. And I think that's where a lot of guys that acted more quickly after that and didn't lick their wounds and got going, found a really great way to kind of get into the game and build those companies up. But yeah, the value add, especially down in Phoenix right now, right? It's just crazy. People are just, the prices they're paying are, it's nuts.
I'm glad I own a bunch of units in Phoenix right now.
Yeah.
But we got an offer on a property this week that was appraised last September when we put some Fannie debt on it. We put 15 million in debt on it last September. We got an offer of 21 on it this week. Like, that's insane. It's like a 3.5 pro forma. Like, come on, So yeah, we think that's a little rich. Actually the Terrells, Pat and Mike sat with me in my conference room in probably 2013. And they were the guys that said, Chris, you got to stop selling these things. You need to start owning portfolios of stuff. That's how wealth is created.
Yep.
We took that to heart, and now we're doing what we're most excited about today, is the industrial value add play.
Yep.
We're assembling this stuff, and just the fundamentals from a risk reward standpoint, I just can't touch it. The third bucket that we didn't really touch on is our development. We've done some retail, like single tenant development, and we do multifamily development. Yep. We've got a couple projects going in Texas right now. 128 units in Dallas, about a $35 million project, and about a $50 million, 170 unit project in Houston, where you're now hometown, I guess.
Yeah, exactly.
Development is our riskiest bucket. The way we kind of see it as opposed to stocks and bonds, we've got debt as our low risk, value add is medium, and development is high risk, mainly due to the deal cycle. A 2 to 3 year deal, we don't have a crystal ball any better than yours.
Yep.
And we expect the highest return out of development because we're taking that development risk. But what we've discovered in the last probably 18 months is this industrial value add play. We eliminate all the development risk. Yep. Because we're buying cash flow the day we close. And we just think it's out of the balance. The market is a little out of balance. There's a huge demand in the southern markets, your Sunshine State markets, where we're buying infill industrial properties that have in-place leases that are below what the market rent would be, because we're having such steep rent growth that are being priced based on a cap rate.
Yep.
So the valuation is based on the in-place income, but the in-place income might be 50% of market income. You just have to wait for the lease to burn off.
Right.
And we are closing on our 14th deal in that package next week. And we've kind of got a system to find these deals from, generally a lot of them are owners that have been using manufacturing or industrial space, and they sell the company.
Right.
They sell the company on a multiple of the earnings. So they subsidize the rent low to get a better sale on their company. And now they have this asset that they kind of shot themselves in the foot from a rent perspective. And the market, doesn't want it because it's below market, because they don't want to wait, because we're a little too big for mom and pop investors. Our deals are generally like 5 to 15 million. But they're too small for the institution.
Yep.
The institution is not going to compete with me on an $8 or $9 million building. Yep. So I'm buying a 6 or 7 cap on actuals. I leverage it with good debt at 3.5 to 4%. Great arbitrage, good cash flow from day one. I let a 3-year lease burn off, and I can double the rent.
Yep.
Double the rent, double the value. So now my $9 million building's worth 18. And all I did was wait and cash flow it. So we've gotten a ton of traction in that particular strategy. And we're trying to assemble enough of it to either take it public, via some type of a REIT offering, or
Right.
sell it to one of the REITs. We've had a few REITs talk to us about buying the portfolio. We're not ready yet. We want to keep assembling it. But that's the industrial play in a nutshell. I can dive deeper into the risk or lack thereof, I think, depending how granular you want to go on it.
Yeah, no, let's dive into it. I mean, because I think like you said, you got your debt fund, which is sort of that income, and then like you said, you've got your riskiest stuff is ground up, right, where you can. But this really sits in, and even when you're acquiring it, correct me if I'm wrong, right? But you guys are probably still generating like double-digit, like cash on cash returns, right? Even with in place, or like high single digit.
So the cash on cash is not going to be double digits on the first layer, because I'll give you an example. We're closing on a building. We're in escrow on one right now. It's $9.5 million. It's 140,000 square feet on 10 acres.
Mm-hmm. So
to build that structure today, it's going to cost me $150 a foot, ignoring the land. Just to rebuild the structure, it's $150 a foot. I'm paying $9.5 million. So I'm paying like 60 some dollars a foot for this building. It's less than half replacement cost.
Yep.
The caveat is I have a 2-year sale leaseback. So the leaseback is at 17 cents a foot. I can't make money. I barely cover debt in that scenario.
Yep. I'm
going to have like a 2% cash on cash in the deal for 2 years. But when I release it, assuming I don't just sell it, vacant, I've been told it's worth about 14 today. But market rent today is 45 cents. So I don't mind kind of neutral cash flow to wait 2 years, because I just don't conceive the situation where a structure that's worth 14 million today is worth less than 9.5 over the next 2 years.
Right.
I just can't see it. And that's kind of the model, right? So we're finding things that it has to have 2 criteria to fit in our box. One is going to be that we are buying it below replacement cost.
Yep.
We know everybody gets hurt when they're paying above replacement cost. We want to be buying below replacement cost, and we need the rents to be below market. And that's what hurts the cash flow. So this fund is going to be somewhere between, I'll say 4 and 8% cash on cash. Depending on how close to market it is. The closer it is to market, the better cash flows, right?
Yep.
But the closer it is to market, the less upside potential we have. So that's kind of the balance. And what we're doing that's a little unique that I'm not aware of anybody else in the country doing is our fund is set up to do a series. So instead of like a single asset syndication or a pooled fund with net asset values like quarterly or annually, we take a group of assets, get the escrows largely aligned, and we call that series. This is series 2. It has 5 assets in it. It's 26 million. We're going to raise $10 million to buy it. And now a bank doesn't love a $9.5 million building that barely cash flows, even though it's worth significantly more. But I'll add another deal that's maybe not as discounted to market rent that cash flows better into that series. So now my series has got some pooled risk, and I've got cash flow from some that are closer to market that offset the lower ones. The lower ones, when I bring to market, give me huge value pops, which drag up our overall IRR.
Yeah.
So, we did a series that we closed last month that did, on paper, it looks like a 27 IRR over a 5-year deal, which that's development type returns.
Exactly.
And 3 of the 5 assets in that one, we got offers while we were in escrow to sell them for in excess of our contract price. Now we've been a beneficiary of a phenomenal period in Phoenix, right?
Yep.
But this is a unique strategy that isn't appealing to an institution because they're not going to go after that minimal cash flow. But we kind of talk to our partners and investors on, we're in this for the long haul. We want to own the assets. We believe in the asset class. These are the acquisition level deals we're going to buy. They're going to cash flow, but we feel a lot more downside risk protection because that's just kind of our philosophy. We look at our downside, not what could go right if everything goes our way. Like that's great to think about, but I'm way more focused on how we get hurt and the risk adjusted returns on these. I feel like it's unmatched. So that's where I'm putting a lot of personal money, and we're raising a lot of money to go after these.
Yeah, no, I think it makes a lot of sense. And it is always finding those little pockets, like you said, where it's just for, the individual investor, whatever, it's too much of a stretch for any given, right? And the institutions, it's just not worth the headache. And they
Too
need
much brain damage.
way too much brain damage, right? And when you look at right now at this low interest rate environment, I mean, 4, 5, 6, 7% is way better than a stick in the eye when you're at basically zero. So even then, it's not like it's zero cash flow. At least it has some cash flow, and that's fine. And it's about the patient, just being patient. Real estate's a long game to begin with, and if you can get sort of the best of really what are kind of both worlds, it just makes a lot of sense to find, especially when you can find a strategy that is sort of got a bit of a moat, for a lot of people. And I didn't even think about the bank side of it. I mean, that does make a lot more sense, is that you bring a handful of deals, a bigger deal, easier for them to underwrite, and then they can get their mind wrapped around it, and as a package, right?
Exactly. So one of the struggles with doing any of these individually is the debt markets are not going to look at 5, 6, 7 million. You got to go to local banks for that. So when we bundle it up to that size, we can get a decent debt check. So we're bringing some really sophisticated kind of strategies to a place where we can optimize returns. And that's putting us in a position to win. We're getting a lot of buy-in to the concept and the strategy, but you hit it on the head. The brain damage involved, I mean, it's a lot. I'd much rather go buy one deal for $25 million that produces a 7, but I don't know anywhere that exists. So we have to do 5 times the work to buy 5 deals that add up to 25 million. But, we also got 25 million deployed. That's going to do, high teen IRR on this latest one. I think we're looking at a 19. I can't hit that with any other activity I know of. And, as because you've been in the business a while, that's kind of how it goes. There's these windows of opportunity where things are out of balance. You got to see those and capitalize on them. And, that's what we're trying to do. I'm not done with multifamily. It's just, I don't see good acquisition targets today.
Yeah, so, no, that's exactly right. And that's how you have to approach it. I mean, it's when you're an investor, that's what I mean. Even for the passive investors, it's just like, I know it's just, everyone's like in love with multifamily. It's easy to understand or whatever, but on the show, that's why I try to talk about, like, I know it's great. Okay. It's like no one disagrees with how great multifamily is, but if you're just myopic on it's all you're doing is multifamily syndications, it just right now, there's a really good chance that, I'm not saying that it's every deal, but I'm just saying there's a much higher likelihood right now that if you put money into a multifamily syndication, that there's a potential that you're overpaying for that property. Your risk goes up because we're at the top of the market. It just, you just don't know. And I know supply and demand and all those things, but it's just like, that's the whole point of diversification. Like, you got to look at other opportunities too.
And you're competing with 50 other guys to buy, you're chasing yield to the bottom, right? I mean, I love multifamily. 3,000 doors is not a guy that's just like, oh, I'm going to dabble in it, right? Like, I've done it and I'm building a few hundred, we'll probably get 4 projects going this year. I still like the economics of building it, but why compete with everybody when you have this like low hanging fruit in industrial? Because let me tell you the other side of it, managing industrial. Do you know what it's like to manage a single tenant, 140,000 foot building? We get 1 ACH a month. We distribute to the partners. I mean, I would much rather have that than deal with hundreds of apartment units. Much rather.
Yeah, that's exactly right. It's far fewer, moving parts, not so emotional, not so operational. I mean, so to that end, I mean, how much do you look at sort of credit quality of tenant? And I mean, it sounds like it's sort of,
no, that's great.
Yeah.
Perfect question. Do you know how much I care about the tenant strength in that 2-year leaseback I just did? I hope he blows it and leaves next week, because then I get to realize a $14 million building next week instead of 2 years from now. So that's, we have a slide deck on the industrial fund and we go through the common questions. Well, what if they don't pay? Perfect. Then we realize and execute our business plan earlier. Now, on the kind of the overall type of assets we go towards, it's not likely that we're going to run into a lot of poor tenant quality or problems through COVID. We had 100% collections on the entirety of our industrial portfolio. And we also do kind of cater, another component of it is we cater to businesses that we view as inelastic, like the waste business or something. Like we bought a building for a company. They manufacture and service dumpsters for waste management and right-of-way disposal, which is, waste management is massive. And another big regional group, dumpsters have about a 5-year service life, and they need a lot of maintenance over that time. These guys make those. We will likely not, as a nation, quit producing trash. We probably are not going to reinvent the dumpster. Our tenant is probably not going anywhere. One of the other ones we bought is a company called US Pipe, publicly traded group. They have about 80% of the market share in the US for underground water pipe for like subdivisions and communities.
Mm-hmm.
They have 28 locations around the country. They have 2, an East Coast and a West Coast, that have these special ovens that do proprietary treatment.
Yeah.
Well, I own those ovens because they're fixtures of the building that I bought. I bought that building last October for $3.7 million from a publicly traded company. And I've been turning down offers between 8 and 10 million to resell the asset ever since. I got 12 acres of land and 60,000 feet of structure. Again, 60 some dollars a foot on 12 acres of land in Central Phoenix. And that tenant can't go anywhere, or he's got to rebuy his ovens.
Yeah.
So it's like, now where we're going with them is we're looking for a site to develop a new location that's specific to them, so I can get them out of that building. Right. So I can redevelop or put a new tenant in, because I actually had to do a 5-year lease back with them. And I leased that to them, and I want to say like 39 cents a foot, something in that range. And the market is closer to $1.
Wow.
So I'm at like 40% of market rents there. It's cash flowing. I want to say 6 or 7 on that one, but we know we'll hit like a 3 or 4x on our equity just by vacating them. Now, obviously, when I say we know, that's in current market conditions. If everything tanked on us, it would be different. But we run a stress test on these where we take all the industrial data, and a lot of people don't know this. Multifamily and residential kind of goes up and down in these cycles like this.
Mm-hmm.
Industrial has been a lot more slow and steady with less, it's been a more curve like this instead of the roller coaster. At least in the Phoenix market in 2008, we had about a 20% dip in industrial asset values, like cap rate compression, or not cap rate compression, expansion went up about 1.5 points during 2008, where in the same market for multifamily, we would drop 90% of value in 2008,
Right.
So
right.
When so we run these stress tests of, hey, here's what happened if we take the last 20 years worth of data, this is what will happen on these assets we're buying, and we're going to get this return. If we look at last year and project that out, this is the return. And then let's run an 2008 stress test and see what would happen on this last bundle that we closed on of 5. 3 of the 5 still made money through an 2008. They didn't make a lot of money, single digit returns, but we didn't lose any money.
Yep.
Because we make our money on the buy. And that's just not something I can run a stress test on any multifamily asset and not lose money. I mean, you're going to get killed in multifamily in that correction. Yep. And when we focus on industrial assets that have kind of inelastic demand businesses in place, you can see why I just am raving about the risk reward profile of this is unique. It's not pretty. You want to go tour this place in the desert where they manufacture dumpsters, you're not going to be impressed, but the fundamentals are there.
Yeah, that's right. And I think that's just, and that's the beauty of it these days, is these are the types of opportunities that guys like you are finding these strategies, executing them. And then the fact that, your average Joe high net worth guy can allocate capital into them.
Yeah.
Right. I mean, like that's, it didn't always used to be like that. I mean, even 15 years ago, you'd never even know that this deal existed. This is like this type of stuff we're talking about right now was stuff that, happened maybe on the country club. If you knew a guy like you just didn't bump into these sorts of opportunities. So, it's really neat when you pan out and think of it that way too. It's just that it's not all, because you hear about this Blackstone and BlackRock and all these big deals. It's like, but it just, you can't lose sight of the fact that, we had this discussion the other day about, institutional quality, right? And I'm going, okay, well, we could argue that what you and I are talking about right now is institutional quality, but it's not institutional. It's not an institutional asset, That's, and that's a good thing. So when you hear the word it's institutional, I mean, I've been in the business long enough to know that usually is a bad thing. That usually means like
if you're on the buy side, it's a bad thing.
You won't like it. Like, I don't,
Yeah.
you know, like, it's just, this is the beauty of real estate. It's inherently inefficient just because it's physical structures and there's, you know, only so much dirt and it's spread out everywhere. And, you know, and you got markets that cycle. It's just, that's the beauty of it. It's that it's this inefficiency, right? These pockets of time or whatever, when you can really, you know, get in. I mean, it's not easy, as you said, but you know, that's sort of how you have to evaluate these things, especially as a passive investor. Like, you're getting into this stuff, you just can't fall in love with pictures, as you said. You have to think like you're Warren Buffett. What would Warren Buffett do? Right? Like, if he was going to get into this sort of stuff, this is the stuff that he would
be buying this stuff up left and right.
Buying this stuff up left and right. Right. And so if he was if he was sitting here with us in the third box of, you know, and we're having this, like, he'd be saying, yeah, it's great. But he'd be saying the same thing we're saying. I need to put out so much money so fast, I could never do that. Right. Like, it just doesn't make sense.
It's just not efficient for him at the scale they're at. But, you know, we skipped over my residential stuff and where that went a little bit. My bidding company became an institutional service provider for a lot of guys who came from Wall Street and started buying up houses. So we were buying in several markets in the US. And have you heard of Invitation Homes?
Oh, yeah.
Yeah. So that was founded by three guys here in Phoenix, friends of mine. That the company that led to that is called Treehouse, still exists. Blackstone backed them with what they thought would be $1 billion venture. They ended up placing 13 or 14 billion into the asset class. I think they went to 28 markets. And I've stated, you know, I've worked with those guys from before Blackstone showed up and still do. Very, very smart guys. They run a mobile home platform with some Blackstone backing today. I watched that, and that's what we're taking the concept to this industrial stuff. It's the assemblage. I made a lot of money assembling SFR residences into pools. And I mean, through 17, I guess I kind of stopped the SFR assemblage, but I still own portfolios of that stuff. And when you can buy something piecemeal and the sum of its parts, I can sell on a cap rate, there's big returns in that. And the returns we're talking about with our industrial stuff, we do not contemplate that assemblage and disposition to a REIT in our underwriting.
Right.
But that is 100% going to be the most lucrative exit. It's just, I'm not going to model and speculate all that stuff today. I'm just going to assemble it all. Instead of $30,000 houses at foreclosure auctions, it's $5 million buildings that we're assembling. And then our exit gets really attractive.
Yeah, that's right. And that is where it's what I tell a lot of guys that I do the consulting on, like the, you know, fund formation or whatever. I'm just saying, you got to like, don't fall in love with a fund model, or like you're missing the point. It's about acquisition of assets. You need to acquire assets to do anything interesting. If you want to try to skip to the end, you can't. It's impossible. You can't say, here I am today and I own 5 properties and I'm going to, you know, we need to account for me, you know, doing, you know, 30,000 of these. I'm like, that's just not how it works, right? Like you got to go one step at a time. Think of it like a vehicle. We need a vehicle that gets us from point A to B. Then there'll be a vehicle from B to C, C to D, potentially. But it does us no good to think about it. But like, to your point, I mean, it's like, okay, well, let's get this going and we'll figure out, is there enough scale there? Is there enough assets? Can we do this? And if there is, it could be a huge winner, right? Because you can, now all of a sudden you've taken something that was inaccessible and made it accessible to people that need to put out 20, 50, $100 million at a time, right? And once again, as we said, they'll probably overpay for it.
And they will. And are they really overpaying? Because at their market, with what we give them, you know, if we could assemble, let's just say 100 million of assets at a 6 cap, which I know I can do that in the next 12 months, no problem. Well, a REIT that has $1 billion to deploy is happy to buy 100 million at a time at a 4. So my 100 that produces 6 is now worth 150 just by assembling it.
Yep.
That's the concept, right? That's what I learned from the residential stuff that we've applied in multifamily, that now we're taking to industrial because we don't see anybody doing it. And we're bringing guys in with as low as $50,000 into the fund to participate. Yeah. You can't make returns like that on a 50K investment, you know?
You can't.
We own a bank. We've been bankers for 12 years. We've been assembling real estate for 13 years. There's a lot of sophistication that goes into that opportunity that you're going to buy essentially for a 30% promote. Like that's a good deal.
It's a good deal. That's exactly right. Yeah, it's great stuff. Cool. So last thing, I'm just curious, for you, it's been a good ride for you. And I kind of got into business too in 2008. So I've sort of got on that and then rode the crazy downturn and have been in it. I'm curious for you though, what sort of makes you nervous these days, having seen a lot, right? And so,
yeah,
what is the thing that does sort of keep you up at night, or that does worry you, that, with an operation like you have too, which a lot of moving parts, you got a lot of people these days, and,
yeah.
What is your biggest concern, the thing that kind of stresses you out the most?
So, that's a great question, Lance. And I'm gonna have a long-winded answer because there's a few components of it. I have been nervous about multifamily pricing for a while. And when we went into the COVID stuff last year, we looked really closely at our portfolio. We were running at the time a 52% leverage across everything we have, which is pretty conservative.
Yeah.
That's a little weighted because I include our debt portfolio in that, and that was unleveraged at the time.
Okay.
So,
yeah,
we had $40 million without leverage on it. That changes some perspectives. But I was concerned more so on where interest rates could go. And then when we pumped all this extra capital into the economy, I'm seeing how that's trickling in and inflating prices and lowering cap rates pretty rapidly.
Mm-hmm.
It leads me to my fear being interest rates rising, not necessarily for our holdings, but more for the market, because as these guys compete and chase multifamily down into the threes,
Mm-hmm.
and the spread of debt to yield is being counted in basis points, a change in interest rates can burn those guys. And I'm worried what that could do to push things off the cliff there. It doesn't make me worried for our debt portfolio. It doesn't make me worried for our industrial portfolio. It doesn't even make me worried about our multifamily stuff. Yeah. But, that's the piece that gives me a little bit of heartburn. Yeah. And I'll also qualify it with, I can't envision the scenario where interest rates do get pushed up on us, because I go to a lot of conferences, and even at the one we were at, mm-hmm. With the economists there, and where they see the inflation and how that normalizes and all that stuff. I have a good degree of confidence in that, but it's a black swan event. Yeah. Because you can't predict it, right? If we could see it in the data, we could do something. So I'm concerned about what that could be, but I don't have any rational basis for it, other than everybody who's ever said this time it's different has been wrong. Yeah. So, that's probably a little bit of why I focus on our downside potential more so than our upside. I know if we keep buying good real estate with good fundamentals, we make money in the long term. And I qualify everybody we talk with, hey, this is long-term vision stuff. We think we can weather bumps because our industrial fund, we run it like a 65% leverage. We're not maximizing leverage, and we know we're taking less yield for that, but we'd rather sleep good than be max leverage and worried, right? But interest rates are probably my main concern, but I don't see the reason. Europe's at negative, so clearly we've got some ways to go. But that's probably where I see risk in the market. And I think guys who are overpaying, if you pay more than something you can build it for, that doesn't last, right? That doesn't work well in the long run.
I call it speculation.
Yeah. So I don't like to speculate. I like to speculate as little as possible. We're all speculating to some extent, right? I have an expectation that things will stay the same. So our underwriting assumptions, this is probably why we can't buy multifamily right now. Large groups, and I won't name names, but multi-billion-dollar, funds out there, they're underwriting like 8, 9, 10% rent growth on multifamily to get the model to work over a 5-year deal to hit a 15 IRR. Yeah, I could never bring investor money in with a 10% annual rent growth assumption, because I just don't. I don't think that's the standard. Unless we keep printing money, I don't see that happening. I mean, we will continue to print money, but not to the tune of, I think we added 25% to our overall money supply during COVID. That's a significant number. Pool of assets didn't change much, just the quantity of money available for them. So obviously things are jumping, you know?
Yep, that's right. Yeah, that's right. And I
Now,
think
I wish I saw that at the time instead of in retrospect, right? But
yeah, exactly. Don't we all? That's right. Yeah, and I think you hit on two things that I think are important, especially for the passive investor too. And I think by their very nature, they often will do this anyway, but it's that, see, even a very active investor is focused on the downside risk. You're entertaining, of course, I want to see what my upside is, but that's not where the focus is. And I think for passive investors, you need to think the same way, which dovetails in the second thing of really being critical. If you love multifamily, you're going to look at these deals that are out there, that rent growth, you got to look at that stuff and say, is that sustainable? Because see, it's easy to make the number say 15 IRR. And that's what I see them going, like, I'm looking, hey, Lance, tell me where your guys are that are doing the really juicy stuff. Like, and I'm going, I don't have them because they don't exist. Like, if they're good at what they do, they're not projecting that right now.
Right.
Because
and we just can't compete, right? Like, we bought a multifamily asset in July that we put in escrow in March, and we think we're up 10% to 15% on it just because of the timing of the spike we had. Not because we were good, but it was a no-brainer to buy it in July, you know, and we don't underwrite rent growth. And it's those assumptions. You hit it so well. Like, yeah, we could put a paper out that says we're going to get IRRs that are insane, but what are the underlying assumptions? That's what you've got to look at. And so that's why we put 4 pro formas: 20-year average, 12-month average, 08 stress test, and then our assumption. And our assumption wipes out any cap rate compression, any anticipated rent growth.
Yep.
So we take all that stuff out to put our models together, and we highlight it as we educate people on making the investment decision. Because, you know, you've got guys out there that are social media guys that say, hey, we're going to give you a 6x equity multiple over 5 years. And it's like, on what basis? You know, I mean, there's no justification for it. And that's who we sell against when we're competing for the same dollars, you know. So we have to educate people on why what we're doing is more realistic, and why they're smarter to look for a 15 IRR with good assumptions than a 25 IRR with poor assumptions.
Yep, that's right. That's exactly right. Well, this is good stuff, man. Well, I really appreciate you taking the time and catching up. This was pure gold. I mean, I think, you know, if you're an investor listening to this, you know, listen to this one a couple times. There was some little subtle nuggets in there that could have been easily overlooked. So thanks so much, Chris. Well, where can they find you guys? Give your web address or whatever.
On the internet is Hanson, Hanson, re.com is our website. And I'm on Instagram probably most often with _Chris_Hanson. But coming through our website, there's a contact form. We'd love to, you know, speak to anybody on your side, the investor side. We're happy to have conversations with people and expand on how we see the market and where we're playing and why we're playing there.
Cool. All right, Chris, thanks so much, man. You take care.
I appreciate it, Lance. Talk to you soon.